This is the one candle that I will trade for the rest of my life, and once you see it, you will completely understand why. I've personally made over $318,000 over the last 8 months, showing real results unlike demo gurus. Now, most traders look at this candle every single day and read it completely backwards, and this is why it's costing them thousands of dollars. Stick around to the end of this video because you will understand the why behind market moves instead of just trading patterns. I will also show you what this one candle is, why it works, why it moves, why it actually happens, and I'll go into actual chart examples and then live trades that I've already taken. I've been trading for the past 3 years, and in the last 8 months, I've made over $318,000. Now, I'm not showing you this number to brag or show off because I was in your position once too. I was blowing accounts repeatedly, always blowing accounts, losing money over and over again, feeling like I was stuck in a cycle. I was watching strategy after strategy, literally binge watching videos, hoping that the next new strategy that I learn is going to be the next big thing that's going to get me that Lamborghini or that luxury lifestyle that I want. I was blowing prop firm after prop firm, literally just blowing money like it's nothing. I know exactly how you feel right now because that was me, frustrated, stuck, and I felt like nothing was ever going to change. But over my 3 years of trading, that's when I discovered my IPD FEG model, which finally turned me profitable using my one trade rule. And once I implemented this, literally everything changed. Implementing my one trade rule helped me not overtrade, and my IPD FEG model is a three-step model that completely changed the game for me because if it shows up, I take the trade. If it doesn't show up, then I don't take the trade. And now I'm consistently profitable, living the life that I want, and having financial freedom, getting monthly payouts just from day trading. Now I'm going to show you the exact candle that I trade every single day and the three-step model that I use to align it with to make thousands and thousands of dollars every single month. And this one candle is going to be the daily candle. So as you know, every single daily candle has a body, a wick up, and a wick down. Now, what does this mean and how do we actually use this? Now, the importance behind the daily candle is that we use this as a power of three, a daily power of three. And what does that mean? It means accumulation, manipulation, and distribution. So market opens like this, market accumulates in the morning in one of the London or Asia sessions, and then we have the wick down, market comes back up, and then we have the high, and then the closure of that wick. And this is pretty much the daily candle, as you can see right here. Bam, body, high of the wick, and then we have the low of the wick. Now, if you use this correctly, this is how you print money because you are pretty much catching the daily candle move, which is going to basically make you the most amount of money. Now, how exactly do you catch this daily candle move? Well, once you understand that candle moves in three phases, right? We accumulate, manipulate down, creating this wick down on a bullish candle. Then market comes up throughout the day, creating the top of this daily wick, and then comes back down and closes. So if you use this to your power, that is when you start printing money. But now the problem is you need to find an actual entry inside of here so you know where the market is going and when to enter. And this is when step number one comes into play. This is going to be market open, 9:30 a.m. to 9:50 a.m. Now, what is actually happening between this time frame? Well, this is going to be when market is accumulating overnight, right? And then when market opens, we're going to have something like this, right? So that actually does not look good whatsoever. So accumulation, creating buy side liquidity and also sell side liquidity. So we're going to have buy side liquidity on top, and then we're going to have sell side liquidity on the bottom. The way that you use this is between a 9:30 and 9:50. 80% of the time, there is a move in the opposite direction that the day is going to go, faking out retail traders. And this ties in perfectly to what I said before on how people read this one candle wrong because they think this is a breakout move going to dump. But in reality, this is just a move coming down, taking out those retail traders so institutional banks have orders to place to get inside of the market. Now, how do institutional banks actually get into the market? Well, as you know, every transaction is one trader goes in and one trader goes out. So, in order for me to get into the market, somebody has to come out of the market and sell. So, the way that banks use this to their advantage is there's a bunch of sell limits and stop limits all the way down here for traders that said, okay, if the market goes up or down, this is where I want to get out. So the banks need to wait for these orders to get filled, which is this move down the Judas swing, faking out other traders so banks can get in, and then banks fill all of their orders in right here. And this is why we wait as well, so we can get those big moves with those institutional banks. So between 9:30 and 9:50 a.m., you are going to have a Judas swing coming down. Now, preferably, you want this Judas swing coming down into a 15-minute fair value gap for the highest probability entry. Now, this is when time aligns over price. What do I mean by that? Is you wait to enter between 9:50 a.m. to 10:10. That is the only time that you are allowed to enter with this model. So between 9:50 and 10:10 a.m., right? You're going to have the same thing right here. Accumulation, you're going to have your manipulation move up, and then right here is where your entry model is. Step number 2 is going to be you have to wait for a fair value gap. So a fair value gap is just displacement in price, and this is when market shows you that it might possibly go up in a different direction. Now, what else do you have to wait, which is a part of step 3? You have to wait for a change in state of delivery. Now, these steps have to happen. This has to happen, right? So you find out your daily candle of 3, a power of 3. How do you know your daily power of 3? Is you mark out midnight opening price, which let's say it is right here, right? You need to be below midnight opening price in order to actually enter longs. You come down, there's a Judas swing between 9:30 and 9:50 a.m. coming down into a 15-minute fair value gap. Once you're down into that 15-minute fair value gap, step 2 and step 3 are going to be you waiting for a fair value gap and a change in state of delivery. The important rule to remember about this is that the change in the fair value gap must be going above the high of the change in state of delivery. And don't worry, we're going to get into live examples as well. And then step 3 is going to be a couple of rules. So, rule number 1 is that the fair value gap has to be going through the change in state of delivery. Okay. That is rule number 1. Rule number 2 is that this needs to happen on ES and NQ at the same time. On ES and NQ, there both has to be the fair value gap and the change in state of delivery happening at the same time. Otherwise, you will not enter. Now we are going to go into live examples so you could see this on actual charts. Going into actual charts right here, going into the morning, we are going to mark out 9:30 open, which is going to be represented by this gray line right here. What do we see before? We see market has accumulated pre-market, which has created buy side liquidity above and then sell side liquidity below. Now, at market open, we need that Judas swing coming up, taking out those retail traders. So this red box is going to represent the Judas swing. And then we need to wait for that 9:50 to 10:10 a.m. macro time. And this black line is going to represent that macro time. Let me zoom in here more. And as you can see, if you follow this down, it's going to be 9:50 a.m. At 9:50 a.m., what do we need to happen? Well, we need a fair value gap, which is going to be marked out right here. a fair value gap, and this fair value gap needs to be going through a low, which is our change in state delivery, which as you can see happens right here. And what you do is you enter short exactly when this candle closes, stops at the high, and you target all the way to previous session lows, all the way down here at sell side liquidity. Now, if I go into the higher time frame so we can actually get the daily power of 3 for this, as you can see, I'm going to mark out this daily candle open. Bam. So going back down in the smaller time frames, I have to go find this trade again happening right here. As you can see, this black line represents that daily candle open, right? So if you remember, every daily candle has a body, then a wick up, and a wick down. So for this example, this was a bearish day. So this black line right here represents the daily power of 3 opening price. So it's going to be basically this right here of market opening. And then as you can see throughout the day, market accumulated right there, came up, and then came back down, right? So accumulation here, Judas swing, which is the manipulation. Judas swinged up, taking out buy side liquidity up into here. And then we have the actual move down, which as you can see, the daily candle came here. And as you can see, also another important rule is that we were above this daily power of 3 and that daily candle. Also going into other confluences, we had a 15-minute fair value gap way over here. I will extend right, drop back down into the 1-minute time frame, and as you can see, we had our Judas swing coming up into that 15-minute fair value gap, like I said, using that 1-minute entry. Chart example number 2, this black line is going to represent that daily candle open. And what we see right here is price accumulates, creating sell side liquidity below, and then buy side liquidity above. In the morning, we wait for price to take out one of those sides of liquidity with our Judas swing, which is going to be represented by this red box right here. And then we need that fair value gap with our change in state of delivery. So that high right there with our, it's just going to say inversion fair value gap, but it's going to be a fair value gap going through the high of that change in state of delivery. Then you enter. Why do you enter? One, because you have that confirmation that you're going to we have that confirmation with that displacement leg up. We are below the daily candle open. We have our accumulation, our manipulation, which is our Judas swing, taking out those retail traders so the institutional banks can get in. And then we have the fair value gap with the change in state of delivery going above that high on NQ and ES, targeting previous day high as our buy side liquidity. All right, now we are going to go into live trade examples of trades that I have taken in the past. So right here, as we can see, 9:30 market open is going to be this orange line right here. What do we see? We see market accumulating first. Then we have our Judas swing, which is going to be this red line represented right here, coming up, taking out our buy side liquidity. Bam, buy side liquidity, and then we are going to have a sell side liquidity resting below right here. Then going further into the morning, we have our change in state of delivery going from this low to right there. And then we are going to have, I'll make it red, the fair value gap. Bam, bam, bam. Fair value gap coming through that change in state of delivery, both on ES, right? You can see the change in state of delivery with the fair value gap going through right here as well on ES here, and then NQ right here. Then coming through the rest of the morning, as you can see, I entered 10 contracts with a super tight stop right after we moved away from this low. And right here, you can still see we have that change in state with that fair value gap right here. And then the trade that I actually took on NQ, waiting for price to come all the way down with I think it was a 3 risk to reward. So letting it play out right here. Bam. And then now, as price keeps on coming down, we create another fair value gap right here, with this candle being my order block. And that means I am able to move my stop loss to a trailing stop. And I'll remove these drawings. You can see I'm up $24,000 on this trade. And then sell side liquidity is way down here. And then I'll just fast forward to it forward. Right here, you could see this is where my stop loss was. It already got hit. But overall, great morning with that Judas swing coming up into this 15-minute fair value gap. We had our change in state of delivery with our fair value gap. And this is what allowed us to enter right here. Entry filled right here, actually, because we entered right when that candle closed. And we had 10 contracts down here, making $34,000 across all accounts on that trade. Now getting into live trading examples. This trading example right here is going to be a long. As we can see, coming into market open, if we find 930, which is going to be this red line right here, we came down, which is our Judas swing, taking out our sell side liquidity right here, and then also sell side liquidity as this red or this blue line down there. Then what do? We wait for 9:50 to 10:10 a.m. macro time. From there, we wait for the fair value gap, which is going to be this tiny box right here with our change in state of delivery, which I will make it red right there. And then as we can see here, I'm entering the trade. I drag my stop loss to consequent encroachment of this consolidation. And then my buy side liquidity, which is these relative equal highs, resting above up here. See how this high is super equal to this high. So you can see this high is super equal to this high. That is going to be my draw on liquidity, as you can see right there. You can see I entered off of this order block and then that fair value gap that I aligned before. And now pretty much you can see we have another fair value gap drawing away, which means I could move my stop loss above even higher. And I am going to see if I can drag my stop even more on the way up to here, because we are going to have multiple inversion fair value gaps on this side. And then as the morning went on, I moved my stop loss to break even with this right here. I also entered another position inside of this fair value gap once we had that move away. And then I am just looking for easy positions to get out, right? So I targeted this inversion fair value gap and then also the high of this daily fair value gap. And I am almost entirely out of my positions now. So going to the end of the trade right here, you could see the relative equal highs that I had as buy side liquidity did end up getting hit right there. I had taken my positions based off of this fair value gap with our change in state of delivery right here. And then we also had an order block. I entered another position once we had another displacement leg to the upside. And then I took off easy contracts at this inversion fair value gap right here. And then the high of this daily fair value gap right there. And then once we started coming back down, it looked like we were going to inverse this daily fair value gap and continue going lower. So that is when I completely got out of my position in total. But if you want to learn my IPD FEG model even more in depth, go ahead and click the link in the description below and you will be able to get my free 5-hour masterclass on my IPD FEG model.